Welcome back to Valery's monthly market call. I'm just going to quickly share my screen here in partnership with Real Estate Magazine. As always, goal of this call is really just to get you all of the information that you need about the real estate market on a monthly basis so that you can better advise your clients. Just as a little call to action, we have a ability now to search by foreclosure listings on our website. So if anybody's interested, just let us know and we'll send you a link to do that. It's kind of a new tool that we're testing out. Things that I'm going to cover today. I'm going to talk about interest rates. Obviously, rates went down. I'm going to talk about the bond yield environment and how it's responding to that, and whether or not we're going to see um, fixed rates kind of move in tandem, and how you can sort of expect the market to shape up over the next little bit as a result of that. I'm going to talk about unemployment and debt, as well as mortgage delinquencies. These are kind of the key points right now from my perspective, weighing on the market. I'm going to talk about population growth because we know that Canada made some changes to our population growth policy, and um, there's some things happening in the housing market, I would say, as a result of that. I'm going to talk a lot about the trade war, and the big reason for that is I think a lot of people are kind of fatigued by the trade war right now and not really thinking about it. But I actually think it's a really important thing because we have the Canada USMCA renegotiation coming up later this year, and I think that there's a lot of posturing happening between different governments. Canada and Mexico just made an individual agreement and had some meetings, and so I think that this whole kind of like trade war thing isn't over yet. If anything, it's just getting started, and probably what ends up happening in our trade agreement that we end up getting as a result of these renegotiations is going to be very important for. I mean, I think we have a bit of a teaser of it right now with what's happening. Okay, so let's start off with interest rates. So first things first, the Bank of Canada dropped by 25 basis points to 2.5%. This shouldn't be news for you. And if you follow one single realtor on social media, I'm sure they let you know. But what I find interesting is that, and I think why this matters is we're actually seeing a higher share. I've put this chart in calls before. We're seeing a higher share of variable rate mortgages. I mean, it's not higher than all fixed mortgages combined, but it's higher than the most popular fixed rate mortgage, which is your 3 to 5 year fixed rate mortgages. So this is, a lot of your buyers and refinancers are taking variable rate mortgages. They think that rates are going to fall. They've been communicating that they think rates are going to fall. And so this could create a little bit more buying power in the market, and it could alleviate some rate pressure on renewers in the market. And so, I mean, I don't think that the Bank of Canada's intention is to do anything with the housing market. I think they don't really care about the housing market at all. And I think I put a chart in the one of the last calls about that, but if not, I'll put it in next month's. But it basically just shows that they have basically stopped mentioning housing in their monetary policy reports. They have their next monetary policy report next month, so I'll make sure to include charts from that in next month's call. So your variable rates are 42% of all rates right now in the market. So we're still seeing greater than 50% are fixed, but variable is more popular than the single most popular fixed term, which is your 3 to 5 years. Now, the interesting part about rates coming down is that the bond market has kind of seen this whole thing a little bit differently. And bonds are obviously, they've come down quite a bit, as you can see on this chart, but they are a little bit, I would say a little bit, sorry. You guys have the right slide up, right? Yeah. Okay.
Yep. Looks
Um,
good.
they're still elevated from that kind of like era that we saw, obviously the pandemic era, but there's no sense in really comparing to that. But even if you go back to like a normal market like 2017 to 2019, I know we obviously had a little bit of turbulence from the foreign buyer bans in BC and in Ontario, but from a rate side of things, like I would call that a normal credit environment where your bond yields are kind of like 2 to 3% range, and your fixed rates are like in the high twos to low three or high twos to high threes. Um, so even if we get back to that, which the bond market isn't really communicating that it thinks that we will, we would be really expecting more of a normal market, not a ripping market like we saw during the pandemic. And there's a lot of speculation basically that this is probably not going to relieve this is actually from CMHC, like almost verbatim. It's not going to relieve stress in the housing market immediately because longer term yields will probably not move in lockstep with the Bank of Canada's cut. So basically, the bond market is calling the market's bluff or the Bank of Canada's bluff, and basically saying that they're going to need to get rates down in the short term, but we will see probably a bit of an inflationary resurrection in the long term. And the big reason for this is it's very clear how much government spending we're going to see. Carney's made some serious commitments to spending on infrastructure and military, and so the government will need more money, and so bond investors are basically know that the government is going to need more money, and therefore they might as well charge a higher rate because it's not like the Bank of Canada is not going to borrow the money, or sorry, the government of Canada is not going to borrow the money, and so you might have a little bit of short-term relief on at least the way that the bond market is communicating right now on the rate environment. You might have a little bit of short-term relief on the rate environment, but from a long-term perspective, it's not super likely that we'll see this kind of like low rate environment last for a long time. And this is in line with some projections from Capital Economics, which shows that they're forecasting medium-term upward pressure on bond yields due to government spending and potentially an inflationary impact from tariffs and the new trade agreement with Canada and the US. And so we will see a bit of short-term downward pressure on rates, but as it stands right now, the projection is that rates will probably come back up within the next year or so, like towards late 2026. So this is an important thing to think about, right? Like if your buyers or you or your asset is really rate sensitive, then you might have a good time to lock in or to purchase. I would say most buyers are more price sensitive than rate sensitive, and so most are waiting for better prices more than they're waiting for better rates. But for the odd buyer who is in a position where, they really do want a low rate instead of a low price, that would be kind of that short-term opportunity for them to get potentially both as prices continue to fall and rates continue to fall. I'm going to talk about prices obviously later in this call. Interesting part about Canada. This is from a Bank of Canada report a long time ago, but I found this was an interesting observation that the reductions that we've seen in interest rates haven't actually made Canadians spend less money on their monthly mortgage payments. And the reason is basically because lower mortgage rates means that Canadians basically just take on more debt. And so it doesn't act like lower rates actually don't improve our household indebtedness and therefore can't necessarily be super positive in their ability to grow our economy. I'm going to jump over the job market now while I'm talking about growing the economy. I think that there's two real big factors here. Population growth is obviously a big one, and we're seeing that kind of unraveling a little bit with a lot of political pressure from Pierre Poilievre on Carney's government to reduce the temporary foreign worker program. And I do think that they'll probably cave to that. They've caved to every other demand that political pressure and populism and kind of what Canadians communicate that they want. The carbon tax was the first one. I think the capital gains tax was another one. Those are two really good examples. I don't see why they won't eventually cave on the temporary foreign worker thing. I know they say that businesses want more temporary foreign workers, but the reality is that businesses don't vote, right? Individuals vote, and so at a certain point, they're really going to have to do what the population wants them to do. But this is a chart from Desjardins that shows that the change in population growth seems to be pretty correlated with higher youth unemployment, and higher youth unemployment matters to me because our future first time buyers, like we could actually end up with a longer term structural problem with Canada's housing market because if we have all of our future first time buyers are actually unemployed, right? So if you have a bunch of first time buyers who today don't have jobs, your 20-year-olds basically is like over 10% unemployment. I think it's like closer to 15%. Then in 5 or 10 years, when they need to have savings and T4s and all of those things to qualify for a mortgage to buy a house, that's going to be a problem. At the same time, over the next 10 or 20 years, you have a record number of baby boomers likely downsizing or deceasing out of their large houses. And so if we don't have buyers, currently we don't have buyers who can afford those houses. But if we don't have any buyers who could maybe buy the entry level houses to take those step up buyers who could afford those houses and move them up the housing ladder, you could end up with a pretty challenging long-term structural problem in Canada's housing market. Um, Unemployment, so the employment rate decreased in August because Canada's population is still growing. So the labor force size increased, and with it, the unemployment rate increased to 7.1%, which is a huge number, by the way. Like unemployment in the US is like 4%, in the 4% range. Um, and so the fact that our unemployment is this high, again, this is a huge headwind for the housing market. I'll get into why in a second. Unemployment seems to be most impacting, and this is where like Ontario is really becoming the ground zero for this kind of recessionary environment that we're seeing in Canada's economy right now, because you're seeing a lot of suffering in the manufacturing, transportation, and warehousing, and the auto sectors. And I'll get to that when I talk a little bit about the trade war more specifically in the Ontario context. But interestingly, the one thing that surprised me here is that construction actually saw an increase of jobs, even though I've been hearing a lot about how you're seeing this huge decrease in construction in Canada. But that kind of just offset the job losses that we saw in the construction sector 1 month prior. And I think seasonal layoffs heading into the winter for construction could be a bit of a challenge. Um, to expand on just how unemployment is impacting different markets across Canada, um, you can see the top three cities are all in Ontario, and the top two cities are both primarily auto sector cities, with Windsor and Oshawa seeing the biggest jumps in unemployment. And then you get down to Alberta, and Alberta has really been an interesting one to watch from my perspective. In the last market call, I did a lot of analysis on the amount of rental supply and housing supply that's being built in the Alberta markets. And if they're also seeing unemployment, I do think, I mean, you're already seeing Alberta rolling over, and I mentioned that in the last call as well. I think that if you continue to see that, I think we'll see a softening of house prices and the housing market in general in Alberta. And what I'm hearing on the ground from agents out there is that listings are taking a really long time to sell, prices are declining, sellers are having to reduce prices. We've heard this story before. If you're an agent from Ontario or BC, it's just now we're finally seeing it spread to other markets across Canada. Will it get to many markets across Canada? I would say maybe the ones who are exposed to the wealth effect of Ontario and BC. So probably your Alberta and Nova Scotia. New Brunswick doesn't seem to be weakening a ton. There's a lot, they actually stand to benefit a ton from the military spending that's going on. But Halifax does have a ton of supply on the go right now, and Halifax also has they're very exposed to any volatility that we might see in the population growth curve in Canada. When population growth is high, a lot of people move out there. When population growth is low, a lot of people come back.
And I know
Uh,
that the cap on university students has really affected Nova Scotia as well.
100%, yeah. I think that piece and like that's impacted a lot. I'm going to do a whole like my next call. I'm going to be doing a lot about that, I think, because there's a lot of new data coming out about it, especially like with Conestoga and like I think a lot of those student rental markets. And so I think I did a YouTube video on it recently, but the reality is that um, that that's a population growth stream that's already been attacked by the government or already unwound by the government, right? They put the cap on international students, and what we've actually seen is we're seeing a shifting of the international student quotas into the Torontos of the world, right? Like you're seeing an increase in international student enrollments at higher quality institutions and a decrease at lower quality institutions. And a big reason for this is because they put quality and financial cap on it. So you have to have like proof of funds of $100,000 now, rather than I think it was 60K before. Or sorry, it was 30K and now it's 60K. And so for a lot of these students, like, they might be coming from families that have money and therefore they're maybe going into like STEM engineering or a more university side trade rather than a college side trade. So sorry, just to jump back to why I think unemployment matters so much. One of the things that I've really been spending a lot of time tracking lately is mortgage arrears. And unemployment and mortgage arrears move with a near perfect correlation, other than what happened during the pandemic period. And I'm of the opinion that until this curve starts moving down, we're not going to see growth in house prices. And as it stands right now, both unemployment and mortgage arrears are rising. And if you take a look at how that tracks against the mortgage rate as well, typically arrears start to rise as you start to see mortgage rates rising. Now we're rolling over as mortgage rates are going to start coming down. So we probably will get to that rolling over phase because the mortgage arrears are pulled forward 23 months here. So I would say we're about a year or two because there is that lagging impact of arrears or sorry of interest rates. Like typically people don't feel the interest rate impact immediately, right? They, even if you're on a variable rate, yeah, you see it immediately, but it takes you, if your payment goes up 500 bucks a month, maybe you start burning through savings first, and then maybe you use a line of credit to cover the difference or whatever. And then eventually you run out of options and then you go delinquent. I guess I'll use that as an opportunity to pivot to the debt market. Canada is still relatively low when compared to the global average on interest rates. And so, I mean, there's no ability for us to capture foreign capital right now, but I think in the fullness of time, as you get to probably 2027, I expect the government will likely just not renew the foreign home buyer ban. And if they don't do that, then I think we will see a little bit of a resurrection of demand from foreign buyers. But again, this is a long time out. I think we have a lot of pain to go through before we get to even thinking about recovery in the housing market. Household indebtedness actually got worse. I think 2 or 3 months ago on this call, I talked a lot about how Canadians were starting to deleverage, and this made me feel optimistic. And that was another key data point that I was observing was that I don't think that Canadians will be able to get to a recovery until we can take on more debt. We're just very much a debt-fueled economy. We rely on it to grow our economy. For better or worse, we can't we just don't have a super diverse makeup of jobs and things that we can do to make money in our economy. And so if Canadians are using debt to grow the housing market, get houses built, build businesses, buy cars, start their businesses, whatever, um, a lack of ability to take on more debt is going to keep slowing us down. The fact that we're seeing Canadians go into more debt right now does make me feel a little bit like we're heading in the wrong direction because you need to have think about this as like an individual, right? If you buy a bunch of investment properties, eventually you're going to hit a cap where no lender will want to lend you money because you have too much debt, or you go to ask for a credit card or whatever, right? They're going to say, no, I'm not lending you any money. If our whole economy or if the sum of all Canadians is holding that much debt or on average is holding that much debt, then you have a very credit constricted market where basically people can't take on more debt to buy houses, buy cars, et cetera. And those are the things that are necessary to expand the economy. People have to be spending money. And as it stands next to our G7 peers, we have the highest debt to household income. There are a couple of other countries in the world that are close to us. Switzerland, Netherlands, and Australia, I believe, are typically the ones that we're kind of jockeying for first place with typically. This chart comes from Hanif Bayat from wowa.ca, who's an exceptional resource on mortgage rates. If you're ever looking to get check mortgage rates, it's just wowa.ca. And this is Royal Bank's delinquencies since 2017, and it just really highlights that Toronto is actually outpacing the national average substantially. This is just on RBC, but I do have delinquencies by other markets. The other interesting thing about mortgage delinquencies right now is that newer mortgages are going delinquent the fastest. So this comes from Equifax, and it shows basically how your 2020 and 2022 and 2024 vintage mortgages are actually going delinquent the most quickly. And they also have a cross section of your 22 and 23 and 24 for Ontario and BC. And so while newer mortgages are going delinquent the fastest, newer mortgages in Ontario and BC are going delinquent even faster. So this tells me that a lot of our pandemic era buyers are the ones struggling, or a lot of our pandemic era refinancers are the ones struggling. And a big reason for that, it's not rocket science, is they took mortgages on super low rates and now they're dealing with that renewal wall. And likely when people take mortgages on super low rates, it allows them a lot more credit than they can technically handle. And real estate's really efficient in this way that it's makes people able to pile on way more debt than they usually could. The mortgage renewal and payment changes seems to be most pronounced. Gray is your 2025 number. Seems to be most pronounced in Ontario and BC, but we're still down quite a bit from your orange bars on all of these, which is last year where everybody saw a very substantial jump. So again, the credit issue that we're seeing forming right now is very much an Ontario and BC story and a little bit an Alberta story. Alberta is kind of inching up towards British Columbia there. And you can see here sort of how your the mortgages that were taken during 21 are coming up for renewal right now. They're going to see an increase, that red bar, an increase in their payment. But then once we get to our 22, 23, 24, 25 mortgages, you'll actually start seeing decreases in payments because in 2022 to 25, we were in a higher rate environment and now we're coming down. So the pain will eventually go away, which is showed on that arrears chart, but it's probably still got to get a little bit worse until we get through all of those 21 mortgages, 21 being an era when people were buying at record high prices as well. So once we get through that, I think that we'll probably be I don't want to say smooth sailing, but I think that we'll be trending towards a better place than we are right now. Um, Change in delinquency rates. This is interesting. This is based on the size of the mortgage. Um, your biggest mortgages are actually going delinquent the fastest, especially in Ontario and BC. So you have Ontario in blue here and BC in orange, and your mortgages basically from 500 to 800,000 and from 800,000 plus are actually going delinquent faster than any other mortgages. So usually you would think like people who can afford these high value houses and high value mortgages are, financially secure people and they are less likely to go delinquent, but it appears to be that the opposite is true, where people who take on more debt are actually having a harder time servicing that debt. One of the interesting things that I observed when I was doing some research on foreclosures was that or in power of sales was that the uh, composition of I went through 4,000 power of sale listings on Toronto Real Estate Board since 2022, and 65% of them were taken power of sale by individual private lenders. And so your individual private lenders are like similar to like mom and pop landlords. You have like mom and pop lenders. So somebody who maybe took a HELOC out of their house or did a refi on their house and took a long-term mortgage and took some money out and then lent that money out to somebody as a private mortgage. Those are the mortgages that are going delinquent the fastest right now and going delinquent at the highest percentage of the total amount. And this is a point of concern for me because that tells me that there's a little bit of um, potential for contagion. Because if those people lose a bunch of money on their private mortgage investments, then that could actually start eroding their equity in their house or damaging their individual household finances, and it could spread to other properties. Um, an interesting data point that illustrates this kind of well is that we're seeing this big trend of parental co-signing on debt. And I know in the last report, I talked a lot about how there was a huge increase in first-time buyers, and a lot of them are using gifts or co-signs. And so we're basically seeing this parental co-signing actually creating a little bit of a draw on older households. So where you can see, I think I've put this chart in the deck before, but people younger than 35 years old actually are seeing a reduction in their change in average household mortgage debt, but older people, so 35 plus basically are all seeing an increase. And the fastest growing is actually your 55 and 65 plus.
Daniel, can
Um,
I ask you a question that we've got here?
yeah.
We've got, is there any impact on us due to the new fees on the H-1B visas in the US?
Um, it's too early to tell. I just did a piece with Bloomberg on this on Sunday, and I would say that there could be. It really depends on like so they already walked it back a little bit from it being all H-1Bs to actually just new H-1Bs. So it's not like we're going to get all of those jobs in the states that are already there. But companies who, US, especially big tech, I would say US big tech who already has offices in Canada, and now is going to have to pay $100,000 premium for any talent that they want to bring in. They might consider hiring that talent through uh, Canada's immigration programs. I would actually say so that's kind of one piece is that you might see big tech come into Canada. You've got Amazon's probably I think Amazon's the biggest H-1B hire. So they have a huge office in Vancouver, obviously. So you could see them maybe trying to bring some talent in through Canada's comparable programs to the H-1B. But I think another very interesting point and way of thinking about this is that Canada has an issue with brain drain. Like we can attract a lot of talent, but we also lose our exceptional talent from places like Waterloo, We train and export STEM talent to Silicon Valley, and um, this is like so if somebody is Canadian and they're going to a US big tech company, they go on something called a TN visa. So we might actually lose more talent as people or lose more Canadian talent as big tech starts to actually shift to easier visa programs to hire people uh, as they're kind of cracking down on this H-1B thing. So as it stands right now, I think it's too early to tell if it goes in either direction. And those things aren't mutually exclusive. Like both could happen, right? You could lose Canadian talent and then it gets backfilled with talent coming in from other countries. But we are pretty well positioned here. Like a lot of people talk about how like Dubai will get a lot of those jobs because they're tax favorable, et cetera. But culturally and geographically, we're the most similar to the US. And so big tech or any company, it doesn't have to be a big tech company, but if a business wants to move, it's probably a lot easier for them to move some of those jobs to Canada than anywhere else. So that's my summary on it. Any other questions while we're here?
No, not right now.
Yeah, I'll talk a little bit about housing supply, try and get through this one quickly. As mentioned in the last call, I went through this a lot more exhaustively. I'm a little bit concerned with like how much supply we're seeing. And Desjardins did a really good analysis on this, and it showed how many unabsorbed units we're seeing in the Canadian market right now. Vacancy rates are increasing substantially across most major markets in Canada. And the other thing is that, we just saw a huge spike in building permits. I think it's record high building permits, which would tell me that there's actually more units probably coming down the pipe. This is amazing for affordability. And as real estate professionals, to be honest with you, we should be happy about it because it means more people can get houses. There's more houses for us to buy and sell or rent or whatever. And usually with supply, prices come down. So this is a really good thing for our industry. It's not a good thing for house prices, but I'm really of the opinion that Canada's economy isn't going to grow if we keep focusing on house price growth. So if my advice for real estate professionals is focus more on uh, growth of affordability than growth of house prices. Um, the housing starts on a per capita basis seem to vary, with Toronto being kind of the lowest and trending down. Everywhere else is trending up, except for Toronto and Vancouver. You see your Alberta and your two Alberta markets are seeing huge increases on per capita housing starts. Again, Toronto is really the one from my perspective to watch the most because it does have the most housing starts per capita, which is the purple bar here. Sorry, least housing starts per capita, which tells me that we could end up probably more likely to have that structural affordability issue if we can't figure out a way to solve our housing supply issue in the city of Toronto. I know CMHC, there's some speculation that CMHC is going to make some changes to the MLI Select program to accommodate better for markets like Toronto and Vancouver. So we'll see if that happens and if that ends up yielding any results for supply creation in those markets. I did a lot about this in the last one, so I'm not going to belabor the point, but we're seeing rental starts massively outpacing condo starts across Canada right now. And so we're seeing this huge building boom, and it's very much not an Ontario thing, and it's very much not a home ownership thing. It's very much a rental thing. And so we're really transitioning more towards a renter's economy in Canada, for better or worse. I could argue either way, whether or not it's a good thing or a bad thing, but I do think home ownership has really been a big wealth building tool in the Canadian market because Canadians basically suck at saving money and suck at investing. And so houses really help them do those things. And if we get that taken away, it might force us to actually find more better wealth building tools, which could actually be more economically productive. But I think it's going to be an interesting thing to observe, and I really do see this being the most important trend to watch in Canada. I think our home ownership rate will be probably 10 or 20 basis or sorry 10 basis points lower, or sorry 10% lower. We're at about 66%. I think we'll probably end up in the 50% range within the next like decade or two.
I had a question exactly on this topic. This person asks, is the oversupply of the housing being built reflective of the form and type that is actually desired, rental versus owner occupied?
No, I would say it's not. I mean, I think most Canadians want to be homeowners. I think like 70+ percent of Canadians do want to own their homes. And I also think the other thing is like it's a lot of it's apartment stock, right? So we are very good. We've gotten very good at building housing. But I would say we're absolutely not building the housing that Canadians want. uh, in form or tenure, right? So a lot of people want ground-based, maybe not single-family detached, but even if it is, like let's say we're building record low single-family detached, we're building record high numbers of apartments, and we're building record low number of ownership units and record high number of rental. And so yeah, I would say I think it's kind of a leading question, but I agree with where it's leading is that it's not. I don't think we're building the housing type that Canadians desire. Um, the interesting thing is in most jurisdictions when we're talking about the rental projects, small deals work, and I think that this is really interesting for real estate professionals. You're seeing a lot of like kind of residential or like resi-commercial realtors getting into that space of the CMHC MLI Select like pseudo commercial space, and I think this is a trend that we'll see continue because small deals are really the ones that are working in most markets in Canada, save for like your Toronto. And even in Toronto, it's not, I think that this is a bit inaccurate in what we're showing. And you can see a decrease in how the high rise stuff or like you can see a decrease in the size of projects that are working on apartment projects. But even in Vancouver, you're sub 100 approaching 50 unit projects. Like these are regular little infill lots that the average realtor might know an owner who has a piece of land that could be developed into one of these projects. And it's even smaller. It's like closer to 25 units in Calgary, Edmonton, Montreal, and Ottawa. So I think that this is something that if you're a real estate professional looking for opportunity to capitalize on what's happening in Canada's rental construction market right now, I think a lot of these small development sites are a really good place to look. Um, I won't rub in condo starts too much, but basically the one thing that I found fascinating was this chart from CMHC that they show that condo starts fell more in areas that had a higher investor presence, and the main area is Old Toronto or like your old core downtown, and then the rest of the city and your Toronto CMA is like the entire urban agglomeration, but condo starts are down substantially in those markets. This chart I already covered. I will skip through this one in the interest of time. So circling back to this chart that I put, the reason I had the asterisk on it on the first time I put the slide up was that I was going to cover it again. We are seeing these impacts of the trade war starting to move through different markets across Canada. And Ontario really seems to be ground zero for this. And the reason is Ontario, the US accounts for most of Ontario's international trade, and it's about 13% of our GDP. And so if these are goods that are subject to tariff that they're trying to get rid of or source domestically in the US, Ontario's economy is kind of in trouble here. And there's about 1 million people employed by industries that export to the US. The biggest one, obviously, is manufacturing. And so your manufacturing hubs are really the ones that are feeling this impact the most, with motor vehicles being the biggest one, with the vast majority of them being exported to the US. Um, and about 20% of the goods that we export to the US are subject to tariffs. So this is going to have a pretty pronounced impact long term on our exports and imports internationally, down about 7% on the export side over the next 5 years should trade policy stay the way that it is. And the question is it going to stay the way that it is? And I'm of the opinion that this is kind of only getting started, and we're probably not going to get an exceptional trade deal offer from Trump when the CUSMA comes to get renegotiated. But I guess we'll see. This will also have a pretty bad impact on Canada's GDP growth, giving us about 2% lower growth over the next 5 years. The real GDP per sector is supposed to decline pretty substantially with an 8% reduction in manufacturing GDP and 22% reduction in motor vehicle parts GDP. So again, your Oshawas, Oakvilles, Windsors of the world are really going to feel this. This will also likely have a huge impact on our job market in Canada, with about 100,000 fewer jobs by 2026 and about 137,000 fewer jobs by 2029. And they estimate that the total change in jobs could be in the hundreds of thousands over the next year. So total reduction of jobs. So we're going to see further upward pressure on the unemployment rate in Ontario and probably across Canada, because typically, unfortunately, I'm not really a downtown Canada kind of guy, but unfortunately, so goes Ontario. goes the rest of Canada in many cases. And so if we do see an Ontario centric recession, I think that it's only a matter of time until that spreads across the country. And so the unemployment rate's expected to increase pretty substantially, up to about 8% in Ontario. I think, I mean, Toronto's unemployment rate's already like 10%. So I would say we're still early innings in the unemployment side of things. They expect it to kind of start moving down after 2026 and into 2027, which seems reasonable, provided the government is able to spend as much money as they say that they're going to, and it's going to provide as much economic growth as they claim. And my big theme with this whole trade war thing is like I think it's taken a backseat for a lot of people. I think people just get fatigued by the news. But I honestly think that this thing is just getting started, and I think that paying attention to what's happening with the Kuzma renegotiations later this year will completely redefine the Canada-US trade relationship. We've already seen the way that Trump wants to be negotiating these deals, and that trade agreement will last a long time, right? Like the original Kuzma was negotiated during Trump 1.0, and it lasted through the Biden presidency into present day. So there are long-term lasting impacts of what's happening with this trade war right now.
Got another question here.
Yeah.
Um, it says, will this be a tale of two national economies with the West stronger and Ontario and East weaker? Policy impacts on different markets?
Uh, it could be. It really depends on, like, I mean, there are tariffs on Canadian oil now, right? So it really depends. I don't know. Uh, Yeah, I don't think so, to be honest. I think that it's going to be pretty broad based. I mean, Alberta's always been an exceptionally like outperforming economy, and I think the prairies have and probably will continue to do well because they have more diverse economies. And I think the remainder of Canada needs to make an effort to get there, provided that we can still trade things with the US that they need without tariffs, like minerals, battery metals, et cetera. I think that the prairies will probably fare better than other provinces, but Ontario does seem to be doing quite a bit to try and ramp up production in the Ring of Fire area, and so that could actually push us in the right direction.
Um,
Um,
ask you
I think,
one more question while we got it here.
yeah.
Hey Daniel, great presentation. Overall, the economic numbers look pretty bleak for the near term. What advice would you give to newish realtors with 2 to 3 years or less experience for opportunities of focus in the GTA real estate market to accomplish their income and career goals?
Um, the biggest advice that I would give to people right now is focus on the people who are actually buying, which right now seems to be overwhelmingly first-time buyers. I think if you go back and kind of tell yourself the first-time buyer story, and I have a YouTube video coming out on this, and it's all of the data that I covered in last month's presentation. But right now, first-time buyers are the ones who are, they were victimized over the last 3 years or 5 years or whatever during the pandemic era, and so they don't ever want to see that happen again. And so they're the ones who are a little bit more eager to get back into the market. And I think if you can understand their needs, what they want, the data that they want, I think a lot of them operate independent of the economy because not independent of the economy, but they're less afraid of the economy because they have such a long buying horizon that they feel like they can afford to take a bit more risk because they're and I don't agree with that, by the way. Like I think that they're wrong because they're the highest leverage, but they think that, and because they're going to be paying their house off over the next 25 years, and they have a bit of a qualitative incentive, and they seem a bit more motivated to try and buy now because they don't want to miss out like they did before. And so I would really just try and better understand the needs of first-time buyers, try and find properties that they're looking for. That seems to be the stuff that's still moving, right? Like anything, I mean, Durham, Ontario is actually your province that is seeing the most increase in first-time buyers. Why? Because they can afford houses. Like the Oshawa thing that I mentioned, prices are coming down pretty substantially in Durham. And first-time buyers are going and buying those houses because you can get a house in the 700K range, which is a great entry-level product. Um, so that's what I would say. And then I would say, obviously, make your calls. And if you can find one single first-time home buyer who wants to buy a house, understand their needs exactly, like to the street, and go and knock on every door on that street. And then get sellers from that process, right? Like this isn't this business is very simple and such that like all you're doing is finding what does a buyer need? What product do I have to find? If you can't find it on MLS, rather than waiting for a listing to keep coming up that meets their criteria, go out and find it. And now you're connecting with both sellers and buyers, and that's how you accomplish success in this business regardless. Um, okay. I'm gonna pivot over to population growth. The thing that we were mentioning earlier here, um, student rejection rates for international students. 80% of Indian international student applications were denied study permits, and we're at 62% of all student applications were denied. And we're at the point where now population growth on a percentage basis is actually stronger in Quebec than Ontario and BC. So Ontario and BC are really feeling the impact of this drawdown on international student growth. And we just saw, again, a record rate of international student applications that were rejected at 62%. So a lot of your student rental markets are really feeling this, especially the ones where prices went up substantially as a result of this international student boom. This is some of the data that I was mentioning, but one of the interesting things that I've observed was that you're actually seeing an increase in approved permits for higher quality institutions and a decrease in approved permits for lower quality institutions. And so, I mean, there's probably a bit of an investment thesis to be found around there, but I think a lot of those college towns where you were seeing a lot of international student rental investment theses created um, seem to be suffering a little bit, and then your U of T, UBC seem to be doing exceptionally well. So I would be paying as much attention as you can to this stuff. This is the list of the cities that saw the highest growth in international student enrollment during that big increase. Some as high as like I think it was one here in 4,000%. Yeah. Um, so these are probably the markets that are going to see the biggest impact as a result, negative impact as a result of this policy change. I'll skip over some of the Conestoga stuff. This is an interesting one from Ben Rabideau. I'm going to give you I've offered this a couple of times on the call, but there's a discount code that you can use for his monthly he does like a monthly report that he sends out to realtors. So I'll put that in the next slide. But so Bank of Canada originally created this chart that showed how rents were very strongly correlated with population growth. And now that they're dropping off, we're seeing rents falling as well because non-permanent resident growth is falling. And I think one of the reasons the government's not super eager to, I'll put the discount code up here actually right now while I mention this. So I think one of the reasons that the government's not eager to get into trying to police away the temporary foreign worker thing is if you go back to the 1990s when we saw our last like major housing correction, um, during that period of time, we saw temporary foreign workers just leave independent of policy, right? Because the economic prospects in Canada were so bad that they were just like, screw it, I'm out of here. If I'm going to suffer economically, I'm just going to do it, back home with my family and my culture and all those things. And I think that that's what we're already seeing, and I think we'll continue to see it. And so I think that um, just like the international student thing, like the rejection rates are high, but also the application rate, or sorry, yeah, the rejection rates are high, but the application rates are also low because kind of word got out that Canada was a bit of this false economic promise, and fewer people were applying from India and China and Nigeria because they felt that it wasn't a good deal anymore. And so I think that they don't want to be um, too high pressure with the policy in Canada and accidentally overshoot the way that they did. But I do think we'll see some changes in the temporary foreign worker side of things. Okay, I'm gonna try and I got 5 minutes here. I'll try and finish off with house prices. House prices right now, as it stands, really seems to be on Ontario and BC story. Prices are way down from their peaks in Ontario and BC, but they still seem to be ripping in a lot of other markets. I do think that we'll see that change a little bit. Saskatchewan, even is one that's on my radar now. Delinquency rates are actually the highest in Canada and Saskatchewan, and they've been ripping. Alberta, we know, is already rolling over. I don't know about Atlantic Canada so much. I think you're already seeing that run in Newfoundland that was happening seems to be flattening out a little bit. Um, I think Nova Scotia, I already mentioned a little bit in regards to the international students' population growth and their oversupply. But um, in as it stands right now, the main story really is Toronto and Vancouver pulling national house prices down. Um, and they're really the only markets that remain in buyer's market territory. The rest would be in balanced market or trending towards a seller's market. Um, the big idea here that you might want to think about is something called the negative wealth effect, which is basically like a lot of capital spills out from Vancouver or from Toronto, Ontario and BC into other markets. And if those people become less wealthy, then they might sell their stuff in, I mean, a lot of Toronto pre-con investors are buying properties in Alberta as an example. If they start selling their stuff there, then that's kind of how you get a little bit of a contagion. And I think that that's probably the big theme heading into 2026. On the bright side, as a result of these price declines, one of the things that we're seeing is housing affordability is improving substantially, especially in the Toronto market with house prices falling. The only market that hasn't really seen a massive recovery is Calgary. But basically, at a national level, housing affordability is trending back down. And you usually see this happen in correlation with recessions, which I'm of the opinion that we're in a recession now. We just got our last quarter of negative GDP growth for Q2 data. Q3 data will probably be negative as well, unless they really crushed it on military spending. But I don't think that they'll be enough to outweigh the negative impacts that we're seeing in the manufacturing sectors. So, where you see on this chart all of those brown bars and the steep decline after the double peak, we have our double peak. We don't have our brown bar yet. We're not in the brown bars are your recession, but we are on that big down, that slide down. And then what you'll see happen is this curve will actually get steepened as rates come down and prices come down and housing becomes more affordable. This is a good thing. This means more people can afford houses, which means that more people are going to buy houses. Um, there was like a big celebration in August about how we saw like the highest August sales in 4 years, but um, I mean, I know I'm naturally pretty cynical, but it was only 25 more sales than August of 2023. So I wouldn't call this a record-setting August by any stretch of the imagination, and it's actually well below the 10-year average, but it is above the long-term average. Obviously, I don't know if you want to be using 1980s data for averages. The bigger thing that I found from the Canadian Real Estate Association data was that supply is massively outpacing demand. So we're seeing new listings going up and home sales basically flat. Active listings are going way up. And to the point where if you go back and to look at August data, you've basically got the second largest spread between new listings and home sales in a month of August that we've ever seen. The only time that we ever saw it worst was in the 1990s when we saw our last major housing market correction. Um, Similar story in Toronto. Active listings are up the second highest jump that we've ever seen on a year-over-year basis at 22.6%. The only other time was May of this year when we actually saw a record number of listings on the Toronto Real Estate Board. So that was the highest supply that we'd ever seen on Toronto Real Estate Board. And I'll hit you with a little bit of a prediction. I try not to make many predictions, but I do think that in September of this year, when the Toronto Real Estate Board data is out, we'll probably see another record number of listings in September. The reason for this is last year we saw a 5% increase in listings in the Toronto on the Toronto Real Estate Board from August into September. If we see the same 5% increase from August into September of this year, we'll actually far exceed the peak that we saw in May of earlier this year. Rents, I only have one slide on, which is basically that rents are falling in most major cities across Canada. And I think that this matters because rents are really like a basis of what an investor is willing to pay for price. So you could see further downward pressure on prices as a result of falling rents. The last thing I'll leave you with here is that um, real GDP per capita in Canada continued to fall, which actually surprised me because I thought because we were seeing so much population growth falling off, we might actually see GDP per capita grow because we did see that little bump you can see, but we've actually resumed our downtrend and continue to fall behind the US. Um, that's everything I got for you today, and I'm happy to do any questions if anyone has them. No questions?
Um, hmm.
That's all right.
Oh, just one thing. Rental rates to fall further?
Yeah, I would say probably. I mean, there's so much supply coming on that, and people like then unemployment's so high that I don't see until supply kind of stops growing at the rate that it's growing and unemployment stops rising and delinquency stop rising. I can't see us getting to a point where rents stop falling. So I would say we probably have another like 5 to 10% downside in rents, to be honest, just based on the data that I'm looking at. 10 would probably be the uh, yeah, I'd say 10 would probably be the one that I would be looking more towards.
As of today, we didn't reach the buyer's market in GTA and KW.
Um, Technically, like I'm of the opinion that we are in a buyer's market. The market's behaving like a buyer's market, but um, technically we're not in a buyer's market yet, based on sales to new listings ratio or months of inventory. But I think August is always a tough data point to use, so I would wait until we have September data to determine whether or not I think we're in a buyer's market, and we'll see that in September data.
How bad could unemployment go?
Um, I could see unemployment in like the high eights to 9%, probably even low nines.
Okay. And you were mentioning something earlier about foreclosure information.
Yeah. Let me see if I can just put that in the chat here. Yeah, we built a tool using our AI at Valery that we were excited to share. I just gotta find it in my chats here. Um, but yeah, basically allows you to pull power of sale listings. It's only for Ontario, unfortunately, but um, there's a handful of different ways that you can actually do this yourself. By the way, you can just search in on realtor.ca in the search terms. You can search just power of sale, and that should pull about a third of the total listings. Um, I can't find this. I'm not trying not to be too self-serving here, but I'm just gonna I just can't find it in my chat, so I'm just gonna pull my most recent YouTube video on it because there's a link under there.
Yeah, you
There
would
we go.
think that in
Sorry, it was playing there. Um, so yeah, the links in the YouTube video, and it actually explains how you can do this as a realtor to just do the search on your own for power of sale listings. Okay, there's a bunch of questions I see in the chat here now too. Okay, share the slides. Yes, I think the slides will be emailed to everybody, so you can use any of these charts for your own little market reports for your clients. Um, the What can the current government do to prevent further real estate price slide? I mean, there's many things they can do. I don't think they should do anything, to be honest. But they could, I mean, they could allow lending to be a lot easier. You go back to like 0% down programs like we saw in the 90s. They could lengthen amortizations. There's a million different things that they could do. They continue upzoning properties so that basically the development value of all properties are similar. They could allow for some or sort of foreign buyers back into the market. They could get rid of the stress test, which will probably happen in Q1 of next year by my estimate. I don't know if anybody knows this, but OSFI is currently reviewing the stress tests, and they're running like two stress tests side by side, one on the banks and one on borrowers. So if the bank one yields similar results, then they'll get rid of the borrower side stress test. So that'll probably be my expectation is that'll happen in Q1 of next year if the test goes positively. But I don't think they should do any of those things, to be honest. I think that the best thing for Canada is that house prices continue to fall because that means it will take more money out of residential investment and put more money into actually growing our economy the right way. Um, any insight on the amount of condo shadow listings that are completing with the Toronto resale market in Toronto? Yeah, so we have about 50,000 closings this year, and about 10,000 of those would be shadow listings. If you just consider like on average, your developers hold back about 20% of their inventory to sell on completion. So that would be your shadow listings in the Toronto market right now. Any predictions on where you think things will be in 3 years? 3-year interest rates seem to be lower than 5-year. What's going to be the situation at year 3 from now? Any guesses? I think rates will come down for 26. I think the recession will be worse than anyone's anticipating. I think they'll probably stay lower for 26, and then I think the government will probably overspend and we'll be back into. I think we'll probably. I mean, look, if you look at historically, we tend to have rates sort of in that like 3 to 5% range. Um, I would say that that's like a safe place for people to anticipate things to be. You don't want them to be lower than inflation, so they have to be a little bit higher than inflation. If we can keep inflation under control and this government spending doesn't spiral too much, then we could probably be, um, I think we'll probably be like kind of in that close to 4% band for mortgage rates, like in 3 years. Um, how likely do you see the foreign buyer ban to be removed? They're not going to remove it. They'll probably let it expire in 2027 because it's political suicide for them to try and remove it. But if they just quietly let it expire, I think they'll be okay. Um, can we touch on multifamily market in a later update? Absolutely. Do you think that it'll be 2.5 years before condo prices level out and start to rise again? I would say probably 27. Yeah, 2027, I think. I think the bigger question is how far do they fall before you get there? I mean, the clearing price, you just saw that project in Milton or Oakville or whatever on Bronte that dropped their prices from like 1,100 a foot to 675, so like 39% drop. I think like and they sold like 100 units or something or 60 units. So we know what the market clearing price is. We just have to accept it, right? Do I think that they'll rise again after that? Probably not, to be honest. I think it's going to be like people think about the housing market as if it's binary, like prices either have to be going down or up, but they can go sideways for a really long time. And that's what happened in the 90s, and I think that'll happen now. With housing affordability improving, Canada moving to a 50% rental model. For those with wealth or long-term investor view, would it make sense to start purchasing multiple properties? Or is real estate investing too risky at the moment? I mean, real estate investing is only risky if you do it wrong, right? If you take on more debt. So you're doing it for capital appreciation, then you're speculating and you have to accept the associated risks with that. So I would say my thoughts on this have never really changed. They were the same in a market that was going crazy up as crazy down. If I can buy an investment that makes sense regardless of whether price goes up or down, then that's a good investment. If price goes up, that's great for me. If price goes down, that sucks a little bit for me, but that's not why I did it. I did it because somebody else was paying my mortgage and I was gradually making money yield on the asset. So I would say, yeah, I think it's a great way for people to build wealth in investing with real estate. You just have to do it the right way and just understand that when you're playing with debt, you're playing with fire, right? Um, the land values decline, yes. Land values have already come down like 30 to 50%. So I don't know how much more downside there is on that. But land values are already down. There's probably a little bit more downside, but not a ton. And what'll be the impact of the rate cut that happened in October? I think that it'll be the same as this one, where basically people realize that it's not going to save them, and it just adds probably more capitulation into the market. During COVID, we saw migration out of Toronto. Do you think that as prices fall in Toronto, that that will happen again this year? I actually think it's probably the opposite is going to happen. You're seeing a reurbanization into Toronto. You get you know the return to work, right? A lot of the 905 markets, a lot of the people who left during COVID to work from home. Um, they all seem to be coming back. Do I ever do reports for ICI real estate? I can add some commercial stuff if people are interested. I'm happy to do that. I'll add it into the next couple. I think that's all I have for time. I'm late for another call, so thank you all for your questions. It was awesome, and yeah, make sure you check out the email and get a copy of this report. And I'll see you all next month.
See you next month.